Lot of people complain about not getting a raise or bonus within the company they work for. But sadly, lot of them do not even enroll in an ESPP plan. ESPP plan, if you're fortunate enough, your employee provides an option to buy their stock. So if you enroll in this plan, it's essentially a free money which can compensate you for the raise or bonus that you are aiming for. So in this video, I'm going to talk about how you can reward yourself with a bonus or raise every year by enrolling yourself in the employee stock purchase plan and provide a strategy to maximize ESPP returns, including tax consideration. So please stay till the end of this video, comment and share the video if you think it added value to you. Okay, so now you may be thinking there are already a lot of YouTube videos, articles, blogs on ESPP. So is there any value in even doing this video? But let me tell you something. You may be surprised to know in 2018, which is 5 years before now, Deloitte did a survey to understand the employee participation in the ESPP plan around the globe. And following are their observation. The first one is to understand the employee participation in ESPPs. You can see that less than 25% constitute almost like 37%, 25 to 50% constitute 32%, 50 to 75 constitute 22%, more than 75% constitute 10%. So you can clearly see the employee participation is very low. Now, in this survey, they also tried to understand what are the factors that influence the employee participation and their interest in the company's ESPP plan. The main thing is share purchase discount percent or matching share features. This particular thing is the most impactful. As you can see, it is like 54% that created more interest or people willing to participate in the plan, followed by 19% in the perceived value of the company, followed by effective communication explaining the plan and its benefit, and then the rest of it were insignificant, 10% on plan features and 1% on share purchase limit. And finally, they were also trying to understand in this survey what were the challenges and management of your company's ESPP. I think the most important one that came out was 52% said effectively and consistently communicating the plan details and benefits to employees, followed by managing plan costs, tax compliance, and so on and so forth. But you can clearly see the effectiveness and consistently communicating the plan details was one of the challenges. In my company as well, when I joined, there was not much details about it. I have to dig and talk to HR and try to understand by myself. So I can naturally see this is one of the challenges for many companies, that they don't have any mechanism. And this also attribute to low employees participation. Okay, now let's talk about how is ESPP employer matching plan actually works. So basic idea is you contribute, you either buy number of shares and employee match that with a free share, or you contribute certain amount and they match to a certain amount. I want to use an example here. So let's think about a case where an employee makes $60,000 annual salary and an employer matches 50%. Okay, and employee can contribute up to 10% of their annual salary. So how does it work? So for example, let us say an employee decide to contribute 1% of $60,000, which is $600. Therefore 50% match would be $300. So basically you get that $300 free money. Let's say if they contribute 5%, which means like 5% of 60,000, it would be $3,000, and 50% of that would be $1,500. Contribute the maximum, which is 10%. That means you would be contributing essentially 10% of 60,000 would be $6,000, and 50% match would be $3,000. Keep in mind, because right away once you contribute this money, the match that you get from your employee is essentially a free money, but also a taxable benefit. Okay, this is a taxable benefit, so this would be right away added to your part of your compensation, and they would be taxed as a nominal rate. Now if you decide to sell that stock, you essentially will trigger, in Canada you will trigger a capital gain. It's same thing in US, and then basically you buy $6,000 worth of stock, and the employee would contribute $3,000, so therefore they would buy $3,000 worth of stock. So that would be your total amount that you buy the stock. Now, if you sell the stock right away, let's say if your company doesn't have any vesting period, really high next day, perhaps you would gain, you would have a gain. Therefore, you will trigger a capital gain. Or if it went down, you would trigger a capital loss. So keep in mind that, basically, if you sell the stock right away, even if it moves a little bit down, you're still ahead of game, because of the fact you get that free $3,000, right? It's only if the loss is more than $3,000, then you would have incurred some loss from your point of view. One thing also to keep in mind is this $3,000 is essentially a 5% increase in a salary. Imagine if you can participate in an employee matching plan every quarter. Let's say you can participate in an employee matching plan for 2 quarters. That means you would be getting 10% increase in salary. And if you contribute 10%, right, you would be getting 10% increase in salary. Okay, so next let's look at ESPP discount plan for how it works. So think about, you work in a company X, and they typically provide some sort of a discount. Typically it is 15%. In some companies they provide 12%, 10% or 5%, whatever may be it. So essentially what they are saying is, if a company stocks trades at let's say $10 value, let's say they provide 15% discount, essentially that means you can go and buy that stock for $8.5, right? So in terms of how it actually works, so think about an enrollment period. Okay, so enrollment period is where you can go and enroll for the ESPP program. Once you enroll, during the offering date, starting from the offering date, the money comes out from your paycheck regularly. Okay, so they keep coming from your paycheck regularly, and let's say after 6 months they go and buy out the share. Basically they take that money that was accumulated sitting in your account, they go and buy on the first purchase date whatever that money equivalent to, right? And then they keep taking the money in the next 6 months, and then they go and buy it in the second purchase date. In some companies they also provide look back provision. Essentially it means you can buy the stock at the cheaper price. Now let's see how it actually works. Let's take a typical example, right? So imagine you are an employee with a 60,000 annual salary. You can contribute up to 10% of your annual salary, and let's say your company's stock is trading at $10. Let's say if you contribute 1% of your salary, that means $600, and given that you are getting 15% discount, which means $10, 15%, it's $1.5. You will get you can buy the stock at $8.5 instead of $10. Therefore, you can buy total 70.5 number of stocks, right? Which essentially means, given that you are getting 1.5 discount for each share, therefore you're getting $105 worth of free money, right? So 5% you get $529 worth of free money. For $10 you get $1,058 worth of free money. Similar to the matching, like any free money you get, like which is essentially the company is giving you the discount, therefore that gets right away added to your compensation as a taxable benefit, and then it will be taxed at a nominal tax rate, right? But keep in mind, here the capital gain works little different. So imagine, let's say, if I have to go buy a stock in a stock market today, it will be trading at $10, right? So, but you are getting a discount of 1.5, so you have bought the stock at $8.5, right? Now, as far as capital gain is concerned, it will only get triggered if the value goes above $10 or below $10, right? And not only that, this 15% that you let's say, so more you contribute, the more free money you get. So the more free money, let's say in this example, 10%, which is $1,058, which is essentially a 1.7% increase in salary for every purchase day. So essentially for every 6 months, you are giving yourself a raise of 1.7%. So that means for another 6 months, you would be giving, essentially for a year, you would be giving yourself a raise of 2.5%. So in both, of course, employee matching plan is always, in my view, is always better than the discount. But nonetheless, both offers you this free money and free raise, which you should be aware. Now, a lot of you may be wondering, like, is there a possibility that I can lose my money by enrolling in ESPP plan? The short answer is yes. Stock market investing is always risky, but I just want to first of all talk about scenarios where you can incur loss. The first one is if your company stock is volatile. So think about a scenario where you are an employee of Tesla stock. The day you purchase, the stock is at $250, and like by the time you want to sell it, it's already like $230. If the discount or matching that is provided by your company is not high enough, for example, let's say your company only provides a discount of 5%. So let's say the stock is trading at $10, 5% is 50 cents. So basically you get to buy the stock at $9.5. In this case, the discount or the matching that is provided by your company is not high enough to offset that margin of safety. On top of it, when you sell these shares, there will be a brokerage fee. See, this is not like your own discounted brokerage, right? This would be a brokerage firm that your company is enrolled with. So they may have a exorbitant amount of fee when it comes to selling the stock, and then essentially you don't want to keep the stock in that brokerage. You want to transfer it to your discount fee. So there can be a fees to that. So if you calculate that everything together, it will be net loss situation. Finally, if you keep ESPP as the only investment vehicle, you don't have any other nest egg or savings, definitely, depending upon how the stock performs, you can incur heavy loss. Okay, now let's talk about what are the strategies to maximize your ESPP return. So the first thing one should do is to buy the maximum your employer allows you to buy. For example, in my ESPP plan, they allow me to buy the 10%. When you buy the 10%, whatever matching they would give would allow you to get that maximum free money, which is essentially the largest raise that you can give for yourself. Okay, so combined with frequent, if your company is allowing you to buy that company stock like every quarters, you essentially are doubling that free money, which would be good in that sense. Second thing is, I would suggest to sell the stock right away and transfer it to your brokerage account. This way it's kind of a low risk here, because think about this way, like when you sell it right away, the matching or the discount that they give, unless the stock goes below that, you would be in a loss situation. Otherwise, you're going to pocket right away that 15% discount. The third point is, like, you can, I always do this. Basically, I wait for a few years. Now, that is based on few facts. If your company is solid, and if you think this is not your main savings and you're okay to lose the money, I'm okay to wait for a few years, because this is essentially a money that I want to try and see if it gives me that extra return, right? So but what I would do for this strategy is wait for a few years. Is like, if I'm in a position where I make more money, basically I'm in a capital gain situation, I will try to employ the stock loss harvesting method. This way I can sell this company's share for profit, and I can compensate with a loss in my brokerage account. This way I can maximize the return. Then finally, what I would do is, whatever money that I get from, either by selling it right away or waiting it for a few years, I will right away invest that money in the low cost index fund. This way I diversify myself, and I can reduce my risk